Welcome, everyone. I am John Ryan, and this is the Predictive Playbook Trading Financial Show. We talk about trades that we like. We talk about the markets. We talk about how to interpret interest rate declines when the Fed hasn't been dropping interest rates just yet. We talk about just about everything that we think is important to have on our radar and possibly your radar as well. And I'm always joined by my good friend and pal and financial expert, Steve Merrill, who adds a little bit less experience. But between the two of us, I think we figured out we have about 60 years of actual live trading experience. And, I think we kind of bring a little bit of value to the table. Steve, how was your holiday? How was New Year's starting out for you?
Yeah, good start. At least from the sports side, last night had Michigan as we
Nice.
faded the public there. You know, it's funny how we always say history rhymes. It doesn't repeat, but it rhymes. It's the same thing with the sports betting markets, just like the financial markets. And I don't want to say Washington was TCU-ish. They were a little TCU-ish. They were better than TCU last year, but it was so similar to what happened last year. Last year, I thought TCU didn't deserve to be in the Final Four. I faded them with Michigan. They pulled the upset, and then we came back and faded them even tougher with Georgia, the biggest blowout in history in the championship. And last week, I went 4-1 on New Year's Day. The only game I missed
Nice.
was, the Texas-Washington game. And the thing is, I don't think Texas is necessarily a top 4 team either, but I just wanted to fade Washington. But we got the nice situation last night. So, it's a lot of times you're a little bit early to the stock market as well, or, the financial markets, and you just have to stick to your convictions. And Washington was not one of the top 4 teams in the country. They're a top 10 team, maybe a top 6, 7, but they weren't one of the top 4. And, they came back down to earth finally last night.
Yeah, they did plummet, but they had an awesome season. They're
They did.
in their own right. How many games did they win by a single score? It was a lot. 6?
Well, it's funny you mentioned that, John, because your neck of the woods, your Philadelphia Eagles, what was it, 5 straight games in which they overcame double-digit deficits about a month ago to win, and they went 1-4 straight up the next 5 after that. So it's a great indicator to look at. People think the point spread is so magical, but all the point spread is margin of victory with schedule strength factored in. And
Yeah.
teams that win by margin usually are better teams. And you could say, well, they find a way to win, and there is something to that. DeBoer is a great coach. And I do think that's one of the reasons they went 14-0, even though they probably should have lost 2 or 3 games during that run, because they were an excellent coach team. And that is something to consider with underdogs. But at some point, it catches up to you when you're winning all those single score games. It's the same thing in other sports as well.
Yeah, so true. Let's start out with the S&P 500. And, over the years, there's the old adage that how the first week in January goes, the whole rest of the year goes. So if that is the case, then I guess we're going to be seeing a bear market. But I learned a long time ago, Steve, that you don't base your trades based on 1 week when there's 52 weeks of a year. But we really did have a pretty large amount of profit taking to start the year. Now we've bounced back with 2 straight days up. We're chopping around today. We're currently down just marginally. But the one thing I wanted to point out here is, this trend is strong. And we have a MACD signal here to take profits and possibly put on some pizza money shorts, which would have worked out. But the trend is still there. I'm a little concerned about the bullish sentiment right now, up at 82, which is the same thing in sports betting. When you have 82% of the tickets being bet on the same team, it's a red flag to be joining them. And if anything, you probably want to do the opposite. So I'm a little cautious here, but I do like, I'll just enlarge it a little bit. I do like this doji here. After 4 pretty hard days down, here's an inverted hammer that I thought would get us down to this Fibonacci number here. It didn't. And it held in and got the doji and we rallied. So this 3-day pattern here looks constructive to me. And this little pullback today, I don't think is anything but a little pullback in the aftermath of last week. How do you see this?
Well, a couple things. I mean, first of all, the S&P was down hard last year. It was a terrible year last year, or 2022. Let me rephrase it, a year ago. And so everything bounced back in 2023, as the market often does. You do get the feeling that maybe you kind of missed the boat when you missed a 20% up year, So I do feel like all things equal, I'd be very tentative to be, jumping in long the stock market now. But as we've always talked about, there is an upward bias. You just blindly play the long, you're going to make money in the S&P over the decades. It's been proven. There's still money being thrown in every week in the retirement funds and the 401ks and whatnot. So there's an upside bias. But There's also the news risk. I mean, just today they're talking about Iran is closer to a nuclear weapon. It's like the defense secretary's been in the hospital for the last 3 days and nobody knew it. I mean, there's a lot of stuff that you could see going bad really fast internationally. And I thought it was interesting too. I think the Shanghai was down like 8% for this past year, if I'm not mistaken. So as good as the U.S. market was, the other powerhouse, economy in the world, China, was down. Um, we haven't talked about this, but like Japan is one that's very interesting to me. I think there's some upside to Japan. They've been in a downward spiral for like a generation and a half now, and they're talking about maybe they might actually start raising interest rates over in Japan. There's a lot of pressure to do that, which we haven't seen since like the 90s or the 80s. So,
Yeah, it's been a
um,
long time.
yeah, I think there's better spots in the U.S. market. Doesn't mean the U.S. market won't go up, but I think the risk reward is better in a lot of the international markets this coming 2024.
Yeah, and I'm going to put up the 10-year note now. These are Treasury notes, and people make the mistake of thinking that Treasury bonds, Treasury notes are like your Series double E bonds that you got when you were a kid from your grandparents, but they're not. And these moves, every tick is $31.25. So with the leverage involved with futures contracts, these moves, if you correctly call them, make a lot of money. So this is the 10-year, and it's the price. So as the price goes up, the yield comes down on it. So the Fed, right in here, was basically, that was the last tightening, and then suddenly there was talk that this would be, well, it wasn't even talk from the Fed. It was just a community type of thing where, well, maybe the tightening's over. Maybe they're not going to do any more. But the market always has, since the beginning of the Greenspan Federal Reserve, always led the Fed, and it's doing it again. The Fed has not eased from its last tightening. They did say, though, in middle of December that they expected to ease 2 or 3 times throughout the year. Well, the 10-year has already done it for them. So the 10-year has gone from whatever the that high was. It was right around 5.05%, and now we're like 3.95, 4% on any given day. So we've dropped a whole 100 basis points already, and that translates to at least a 50% ease during the first quarter, in my opinion. And the Fed, the fact that the only thing they adjust is the Fed funds rate, and that's the overnight rate that banks charge each other for loans to cover some holes in their balance sheet. It's nothing. It's just to make sure that the balance sheet assets equal the liabilities. It's nothing funny. It's just what they do. And the market now has already, kind of put the seeds in place for the housing market to have a good spring, I think, and get the availability of the supply of homes on the market to increase a little bit, of people now saying, okay, well, now I'm going to sell. Now interest rates are down a little bit, so I'm going to take advantage of it because I can afford it. And I think the market for housing will improve greatly. But what do you think about interest rates in general for the year?
Well, I mean, first of all, if you just look at the end of October in the S&P or the 10-year, it's almost the identical chart pattern. I mean, they've gone hand in hand. So that's another reason I think the stock market 20% up year or whatever could be a little misleading, because it basically was just the interest rate game, and it was like the year before 2022, which was so bad, as I mentioned, it was like only the second or third time like in a century that both bonds and stocks got hammered at the same time. The whole 60-40 portfolio was horrendously awful in 2022, which is another reason that's not diversification. Everybody thinks do a 60-40, you're diversified. You're not. You've got 2 assets, and they both went down in 2022, and you got hammered. But yeah, I mean, it's really, look how correlated they are. You look at that low in October in the S&P, and that's also exactly the low that you talked about when things turned in the bond market. So they really are the same market right now.
Yep. And here's the S&P again. And you can see it right here.
Yeah, I mean, it's still like to the day. It's crazy.
Yeah, it's very unusual that they run hand in hand. There'll be some kind of disjoining of that movement. Maybe the prices of the bond market keep going higher, yields lower, and the stock markets go through a little, not little, but I could see a 10% correction from these highs. I mean, some of these stocks are, we're trading in Pluto land, including the likes of Apple, including Microsoft, including Google. The list is pretty high when you just simply look at the price earnings ratios. So It doesn't mean that it's the end of the bull market either. But I do think we're going to get to more new highs before we actually have that happen. As long as interest rates don't, well, let me put it this way, Steve. As long as you don't get some ridiculous statement from the Fed saying that they're still considering tightening, which would be mind-blowing, I think the market will be resistant to having a 10% decline.
Right, and let's not forget that the NASDAQ was up almost 50% over the past year. So we talk
Yeah.
about like the 21 or 22% gain for the S&P. The NASDAQ was more than double that. And those names you just mentioned, Apple, Facebook, all those, they're tech companies. So that's exactly what happens when the interest rate environment gets better. And that's why the stock market ran for a decade, because interest rates are zero. So where else are you going to put your money? When rates are zero, you got to put your money in equities because you're not getting a return anywhere else. What's been a little surprising to me is that the market did run, because like you said, they normally don't move together. When you can get 5% risk free on like a T-bill or cash right now on interest rates, that's pretty appealing to me still. And yes, sure, you missed a nice run in 2023, but you also would have saved some money in 2022. I still think having money tied up in cash at 5% right now, risk free, is very appealing, especially since I feel like maybe you kind of missed the run this past year. And the other thing I'll say too is that the market, like you said, should not be correlated so closely to the bond market. The stock market, the bonds are supposed to be a hedge against the stock market. And that tells me also that maybe something isn't so great in the economy that everyone thinks the stock market's roaring. If it's moving just because of interest rate policy, then you can make a case that things aren't really good in the market. And, now that that's not going to work anymore, then yeah, I don't know. I just think there's a lot of strange things going on right now. That the fact that those two charts look identical for the last 3 months is not normal.
It's definitely not normal, and neither is this 2024 year going to be normal with the election in November.
Yeah, good
So
point.
that'll be some cross currents for sure between the competitors, so to speak. It's kind of like who would it be? It would be like the Patriots with Tom Brady going up against the New York Jets. That was a hated rivalry back when Brady was there. I mean, it just seemed like Belichick just wanted to drill them every single time they got together. Maybe not the best of analogies, but there's going to be cross currents in the market based on news, and that'll probably present some great opportunities too. Now, hats off to you, Steve. We've been talking about natural gas and this floor down here that you were talking about, and look what's happened here from mid-December till today. Huge move in natural gas, went from basically 240, hit a high today of almost 340 in a pretty quick fashion. And if you had made this trade using natural gas futures, you would be smiling ear to ear right now with this tremendous move. What do you think is next?
Yeah, and people are like, oh, I missed the move. Year to date, it's up 25%. Over the past 1 year, it's still down 47%. And that's with it being up 25% this calendar year. So there's plenty more to go. And the whole key to that, of course, was the risk reward ratio. Now, if you look back in mid-October, it did make that recent high. I'm looking at the UNG, which is the ETF, which is easy for people to trade. The UNG ETF was like almost right at 8. Got at the end of December, got as low as 4.5. You see, just a 50% retracement would be in the 6 range. It's at 6.5 right now. So it looks like it's done that 50% retracement. But it kind of went through it hard today. So we'll see what happens. I mean, this week's been good. But yeah, it's just a typical risk reward, trade. That UNG, by the way back was at like 12.5 just a year ago. This time a year ago was 12.5, and now it's 6.5. So there's still plenty of upside.
And there it is. It's right there. It's 12.5 right on the very end of the chart. And now this is clearly a sea change event in this market, no doubt, especially in light of one of my favorite markets to trade is the good old crude oil. And that has no correlation to natural gas, but they are fuels. I mean, they're energy. Crude has a market sentiment of pretty low, 15. So that means 15% of people involved with this market are bullish, 85% are bearish. And that doesn't mean that this market can't go down more. And I do think it's heading lower. Gasoline demand is down, and it's accelerating. And whatever the reasons are, they're macroeconomic reasons that are going to be there for a while. And I still think that this is it's going to keep tracking lower. Here in the East Coast, we actually had gas prices at 295 for the 87 octane unleaded. So I wouldn't be surprised by the time we get to March, it's going to be down closer to 250 than it will be 325.
Yeah, and if you look at over the past year, it's up like 1% now. And year to date, it's down like 0.25%. Last 6 months, down 0.5%. I mean, it's basically been flat now for 6 months. So you can make an argument it's kind of a sideways channel. And I think whichever way we see it break out, that's when you get in. And it'll probably break more likely to the downside. But it's been trading really in a channel since early February 2022. So it's almost been 2 years now. It's been somewhat range bound over the past year, in that 70, 80 range. But historically, we see it get down to the 30s or 40s. Shoot, it went negative for a day back during COVID.
Yeah, it did.
And it's a controlled market. That's something you have to keep in mind about oil, which is so different than even natural gas, the others. There's the cartels, OPEC, the other big nations. It's controlled, and it's so obvious what they do. Like they let it run and they gouge. But then when they gouge too much, they know they got to let it come back down, and they kind of get people complacent again. And I think we're in that downward trend that we often see, and then a couple years from now, they'll be gouging again. But it looks like the downside has more upside.
And you know what? At the end of the day, on a macroeconomic level, this decline in crude oil has basically erased any concern I have for inflation.
Yeah.
It was an inflation scare. It was justified. It was a blip. And now the dominant multi-decade trends are coming back into force. So that too is going to lend itself to a higher stock market and lower yields as the year goes on. Because I don't think these high. This is actually heating oil, 258 on the open market for heating oil, which is pretty low. There's no tax on heating oil in most states, so to get delivery now, heating oil is right around $3 for people, which is much, much lower than it was when we were back here in September. And that's only 4 months. So again, I think the Fed's going to be easing a lot more than 3 times. And the longer they wait, the more times they're going to have to catch up to what the market is telling us. I know you have to get going. I wanted to talk about Bitcoin real quick because that was a stellar performer last year. I didn't change the Fibonacci retracements yet, but you can see, we're only 13,000 from the price where we shorted it twice. If you remember those days, I've done. I have never gone long Bitcoin. I've shorted it twice, and I missed this run because I really conceptually still don't understand. I don't have time to really read it and understand it. Until I understand it, I'm probably not going to be buying the long side, especially at these levels. But the market is strong, clearly. But do you have any understanding of this?
No, I was going to say, it makes me feel better to hear you say that, John, because I consider you and I both smart guys that are pretty well versed in different aspects of life. And I get the whole thing that the blockchain's the real thing. It's not Bitcoin, it's the blockchain technology. And that, I don't know. I've looked into it several times. It still confuses me to this day. And I'm not ashamed to admit that either. What's amazing about Bitcoin is if you look at some of these charts going back to 2012, when it opened like at 5, the initial Bitcoins were around $2 to $3 at one point. That means the current price is a 429,000%, 429,000, 6-digit percent increase. I mean, it's just, you don't ever see that on any other equity or financial metric. So that alone, John, is strange to me. That doesn't I can't comprehend that either. And it plummets, like you said, from the 60s down to the 20s again the past couple years. Something we have to point out, though, it actually might happen tomorrow. The rumor is it could be as early as tomorrow and Wednesday. They're going to give approval for a Bitcoin ETF. It's going to open the floodgate for about 10 different ETFs over the next couple of weeks. That has been why we've seen this run over the last several months. Keep in mind, at the end of 2022, it was around $16,000, $20,000. It's doubled over the past year. And that's because it's a buy the rumor, sell the news. So you do have to wonder if we're going to have a little downside once those ETFs go live. And don't forget, as you know, when the CME started Bitcoin futures back, I believe it was the end of 16, around that time. The night it opened was the all-time high. It was around 20,000, plummeted back down to like half. And then 20,000 was that initial breakout then in 2020, about 4 years later. And then that became the floor for the past year or so. It always barely hovered below 20. So you can make an argument if this is the case, then we'll see it probably drop down to the 30s and it eventually hit the 40s again. But if history repeats itself, like I said earlier, this is very eerily similar to what happened with the futures exchange. It got run up to 20,000 the minute they went live and never hit over that number again.
Yeah, this is a weekly chart of 3 years, and you can see like the sentiment is pretty outstanding in getting the troughs. Now sentiment is a bit overdone, and then I have this social sentiment, which is social media and people talking about it, and it's getting wildly bullish. As Greenspan said, irrational exuberance in 1998 when the internet stocks were going to Pluto, and not one of them was making a dime. At that time, I'll never forget. There was a company called Gadzooks had a market cap higher than Citibank back in 1998. I remember having that conversation with a good friend of mine when I was working on Wall Street. I'll never forget it. But
well, I mean, the similarities are eerie too, because there are some, these digital currencies, these coins have come out like Dogecoin and stuff the last couple of years that were just complete jokes, and they still get run up as well. So it does remind you of a lot of the dot-com bubble, but don't forget, you just said 98, 99. That bubble didn't burst for another year after that. So
right.
Another favorite saying of mine is that the markets can remain irrational longer than your trading account can remain liquid. So there again, you don't want to try to catch those falling knives, or in this case, dodge a speeding bullet. You want to see it turn. Of course, the tricky thing with Bitcoin, as the chart shows, when it turns, it can turn fast, and you don't necessarily have time to get in at the right entries if you're doing like a weekly trade. So it's a tricky market, but once again, any market that's gone up 429,000% over the last 10 years is kind of hard to quantify.
Oh, it is. I wanted to talk about DrafKings real quick. I know you have to get going.
Yeah.
Oh my goodness, what is the DrafKings? Is this? I think no, it isn't. What is the ticker for DrafKings?
It's like DFKN or something like that.
Yeah, DFKN.
Or DKNG maybe.
Let's try that. There it is. That's a 3-year chart. Let's get back to a daily.
DKNG, yeah.
1 year, 1 day. So it did well in 2023, and I like what I'm seeing now too. This is kind of like an ABC type of correction here. It looks like we're ready to start another wave up that would take us to like potentially 42 to 44. So make a long story short, I'm bullish on this and continue to think that they are going to continue to grow as the last remaining states, albeit big states, California, Texas, still have not. Imagine being at the game last night and you can't bet it, Steve. I was thinking about that in Houston, Texas. I mean, the biggest game of the year, and you can't make a live in-game bet there. They're missing out on a lot of revenues. I think Texas and California are, but nevertheless, I think DraftKings is doing a good job. I think we're going to keep tracking this. I'll stick this in the show portfolio, if you will, along with the natural gas and the other trades we've recommended, and keep a running total of how well or how bad we're doing. Because there is no guarantee, but I would like to think between you and I, we can come up with some gains that just might outperform the overall market too. Any last comments you have?
Yeah, I was going to say on this one, it really looks like 30 could be the new support level, and it's right around 34 now. So I think the risk reward's pretty good, because if you look at that breakout from earlier last year, the high back in August of last summer was around 34. And then it never got above that again, but then it broke out here recently in early November. That huge 1 week up broke all the way out above 34, and that's kind of where it's hovering now. So I think if you have a long-term perspective on DraftKings, like it sounds like you do, this probably isn't a bad time to enter, because it could very well be the floor right now, like a new upside from here. It was as high as 60 a couple years ago, if I'm not mistaken. So there's definitely some room for it to run.
And interesting on the social media portions here, we have neutral, positive, negative readings from social media about DraftKings. So coming into today, there was only a reading of 29 positive, 36 negative, 57 neutral. You add the 57 neutral and negative together, and it shows that not many people are bullish on this stock. And that should help propel this thing as it keeps climbing. More and more of these people that had shorted it, institutions shorting it, are going to have to end up covering it. So, any last thoughts here, Steve, before we conclude the show? If anybody's wants a specific ticker symbol mentioned in our next show, put it in the comments section, and we will get it on the next show.
Sounds good. And I still think in general, I would probably be looking at international equity markets more than the U.S. market in 2024. Japan's maybe one we'll talk about a little bit next time.
That sounds good. Anything going on at WagerTalk?
Oh, yeah.
Sure there is.
Doing the college basketball show each day around 2 o'clock Eastern. That's up for today. Also have 2 best bets tonight in college hoops, and also a free play, daily free plays, Steve Merrill, WagerTalk.com.
Great stuff. Well, that'll conclude this show. And always remember, I like concluding the betting shows the same way as the Wall Street shows. Invest with your head and not over it. Bet with your head and not over it. And may all the profits and wins be yours.